here. An increasing and common refrain we hear from consultants and wealth managers is that the South African market is too small for investment style to be relevant. I don't know what investment style means, but Geoff Blount is going to tell me. Hello, Geoff. What do you mean by investment style, first of all?
Evening, Lindsay. Investment style has been around for probably as long as investing has been around, but I think it was first clearly identified in the 1930s by Benjamin Graham and David Dodd as an approach to investment. And what they observed was that at times certain parts of the market in terms of valuations, at times cheap shares did well, shares that would be on low PEs or high dividend yields, so low price earnings ratios or low price book ratios, and those were where all the action in the market was. And at times you had areas of the market where expensive shares did well. Shares on high PEs did well, low price to books or low dividends. And an investment style is just trying to understand the dynamics between market sentiment and what drives different phases of the market. Because there's definite cyclicality to that. At times cheap shares do well, attractively priced shares, and at times more expensive shares do well. And I think it's just trying to unpack the psychology of that.
Before we go to Eugene, Geoff, I just want to refer to that intro that I gave. The South African market is too small for investment style. Surely that's not the case. I mean, why should size matter, in this case anyway?
Well, in terms of that observation, I think that we are probably 4 to 5 years into what we call a strong growth market. And so as a result, investors and commentators are starting to say, well, hang on, the same, so the trend now is your friend, the trend's going to stay in place. This time it's different. This time valuations don't matter. And so therefore style doesn't matter. And by inference then style doesn't work in South Africa. Obviously we would disagree with that. I mean, if you look at a market just with two shares, say one trading on a PE of 20 and another on a PE of 10, the average PE of the market is 15, but one is clearly more dear relative to the other. The issue is trying to understand why the market's willing to pay 20 for one and only 10 for another.
Eugene?
Hi, Geoff. Yeah, I mean, I think adding to that, a share at a PE of 20 can maybe have a annual earnings growth of 25 or 30% expected over the next 5 or 10 years. Let's just take a good story like Discovery or Aspen. Does it justify then to have a slightly higher PE, or if the company's got a superior ROE expectation over the medium term?
No, Eugene, you're spot on. I mean, certain shares warrant a higher rating given either their quality or their earnings prospects, their sustainable ROEs. Does the business have a moat? Does it protect its income or its revenue? Does it have some intellectual property which gives it an edge over the competitors? So, the case is not to say, well, everything deserves to only buy shares that are very cheap or only buy shares that are below average in terms of their rating. Definitely certain businesses warrant a premium. So in that case, the market is saying, well, the share on the 20 PE is likely to grow its earnings ahead of the market, or its quality is so ahead of the market that it actually is worth paying up for that share. And conversely, if a share's on a PE of 10 or lower, the market's saying, well, hang on, right now I'm not so keen on this. It's probably recently struggled and its near-term prospects aren't looking so good. So the market is sorting shares based on these expectations. I suppose the observation as a style investor, whether you're a growth investor or a value investor or a GARP investor, someone who sits kind of in the middle, is that you'll have different perspectives of what that share is worth, the fundamental value. So a value investor might say, well, hang on, even though the share is a great business, the share on a 20p is a good business, it's got good prospects, I don't think those prospects are sufficient to warrant the 20. And a value investor might conversely say, well, the share on a PE of 10, a lower rating share, the market is probably too negative on its prospects. In fact, it might recover its earnings might sit up sooner, and therefore the multiple of that share will go from 10 to 15 sooner than people expect. So again, it's all a matter of perceptions. What we do know empirically, though, is over time, if you overpay for an investment, however you want to measure it, you're likely to your returns are likely to be low. How do you turn a great business into a bad investment? You overpay for it. And historically, over time, we know that value investing or fishing in the lower priced shares tends to outperform fishing in the higher priced shares, the shares on higher multiples, higher PEs, or and the like.
You on this point, because sorry, Geoff, because we were talking about this on this very show last night. I think it was one of the commodity stocks that was on a forward PE of 7.4. Was it Exxaro? Was it Kumba Iron Ore? I can't remember. But anyway, the point is, it was a share that is involved in digging stuff out of the ground in South Africa with all its inherent problems and selling it overseas with not so many problems, but a couple here and there, versus the one that we keep on talking about, Naspers, which is essentially, say, on a 74 times PE ratio, which is 10 times the commodity stock. So I mean, it just shows you that at some stage these two have got to come together. You say there are many investment styles ranging from top down, bottom up, momentum and GARP, that's growth at a reasonable price, value and growth. Is it, you say it's the last two you wish to focus on, but first of all, what is your style at Cannon?
Okay, well, clearly Cannon's a deep value asset manager, and I think we're one of the last few left in the country. Given the fact that growth as an approach, Naspers and SABs and Richemont, shares that are great businesses, but have become immensely expensive, at least to our mind, as investor enthusiasm has probably got carried away with these shares, or the potential these shares present, means that sort of value has lagged as a style over the last few years. And hence many investors have either given up on it, or people that previously said they were value have sort of migrated and style drifted away from it. But the critical issue is that at some stage, using the example earlier on of a share on a 20 PE versus the one on the 10, in your case on a 70 PE versus a 7 PE on Kumba versus Naspers, at some stage you've got to sit up and say, well, hang on, no matter how rosy the future is, paying a 70 PE or a 50 PE or a 30 PE, at some stage it's not a good investment, and you're overpaying. In the near term, momentum's with you, because investors like momentum. They like to follow the crowd, they like to follow the herd. So in the near term, momentum will back you, but in time, we believe you'll be disappointed.
Eugene, you've got style because you wear no tie on mainstream television, but what's your investment style? Would you concur with what Geoff has just said?
Not fully, but partially. I believe you balance your valuation with potential growth. So I think the danger of being a deep value investor is that you sometimes get sucked into what they call value traps, companies that really bombs out. And it makes the deep value investor job extremely difficult. So I agree with Geoff in the sense that you cannot overpay for a stock. And I think a good example is Shoprite at $200, where the growth was wonderful and the story beautiful, and there was a lot of momentum in it. And the true fundamental value of the company didn't really make sense. However, at $145, even though it's at a high-ish PE, the company is most probably going to revert on its ROE, and it's most probably going to crawl back to around the 35, maybe a 40% ROE. And paying a more elevated PE is justified in that environment because the growth potential is huge. And I think that's sort of where our styles differ.
Deep value investors would have looked at Telkom with enthusiasm,
Absolutely.
whereas you would have looked at it with a jaundiced eye. I think you need to wrap this one up now, Geoff, in the last minute. Tell us about the style,
I think
just talk about investment style.
Eugene makes a very good point. I mean, the problem with value investing is that you're often trying to catch falling knives. These are unpopular shares, they're hard to own, and you face greater investment risk. I think for that reason, if you're a value investor, you've got to couple that with a high degree of focus on quality. Many shares are cheap because they deserve to be cheap. So the focus has to be on the quality of the shares. If you can get a cheap quality share, that's much better investment than an expensive quality share. So quality is, I think, a second critical component as a value investor.